We're going to start this evening. Les Mayhew is going to do a scene setting for the topic, and then I'm going to ask Craig to present his paper. I'm sure many of you know Les, but Dr. Les Mayhew is Professor of Statistics at Cass Business School. He's an honorary fellow of the Institute and Faculty of Actuaries, a member of the Royal Economic Society, and a former Whitehall senior civil servant. He's managing director of Mayhew Harper Associates Limited, a research consultancy specialising in the use of large administrative data sets, and a member for the Office of National Statistics expert panel advising on population projections. He's widely published with research interests including health and social care and pensions. His current research interests include paying for long-term care. Thank you, Les.
Thanks very much, Bill. So let me begin with just a few slides of introduction, just to recap how we got here. How we got here really started with the Dilmont Commission of a few years ago. And the key recommendations of that commission, which were ultimately accepted by the government, were to have a cap on eligible care costs, so individuals would not necessarily face catastrophic costs of care. It's noteworthy that that excludes hotel costs. And by the way, this only applies to England, and the situation in Scotland differs, but I'm assuming that apart from Craig, most people here would look to the English policy on this rather than the Scottish. I may be wrong. Secondly, there would be a revision to the means testing thresholds to extend state support to more people. In their argument, they said this may prevent some people having to sell their homes at the point of need. Next, new eligibility criteria that would be portable between local authorities and be introduced to ensure greater consistency and fairness across the system, so that two people in a similar situation but living in different parts of the country would be treated equally and fairly. In fact, it's not quite turned out like that for reasons which I might touch upon, but that was the recommendation. And then the question of people who entered adulthood, which we're not really going to talk about this today, i.e. they turned 18 and they had care and support needs, they would be eligible for free state care immediately, but we're not going to talk about those today. This year, the Care Act, which is the culmination of all the political and other discussions that went on around the Dilmont recommendations, was enacted in 2014, and it has these key features which to some extent go beyond Dilmont but were deemed absolutely necessary to make it work. Key among these was providing people with information and advice relating to care and support, given that it's such a complex field with many traps and pitfalls. Undertake this assessment process, which I just mentioned, whether care is needed or not, and if so, what those needs are, and the same would be extended to carers. However, just being assessed for care doesn't mean to say you get it for nothing. It depends on your means, of course, your income and your assets, but it also only applies to something that they call eligible needs. Now, as part of that process, you need to, or they will be required to, keep an up-to-date record of the accrued costs of their care, a so-called care account, to make sure that they do not exceed the cap, or when they do exceed the cap, other arrangements kick in. And as part of that, to undertake a financial assessment, if required to do so. It might not be necessary in every case. In some cases, it will be very obvious that the person hasn't got enough income or won't meet the asset, or will easily meet the asset tests. In other cases, people might be very wealthy and easily be out of range of any potential state support. There's a final option which would allow costs to be deferred. In other words, the local authority would pay those care costs for the individual. I'm not talking about self-funders here, obviously, but we're talking about people who typically would be income poor but asset rich, which would give them theoretically time to decide how to and when to dispose of their property, whether when they die or beforehand. But as those costs accrue, the local authority would charge an interest on that loan. Now, the new fly in the ointment is the publication in the last couple of months by the King's Fund. Now, how much traction this will get, I don't really know. It seems to me that this might be written for a new Labour government rather than the existing government, so you'd have to work out the probabilities yourself of what might happen in next year, when is it next year? The election is due. And this idea combines a number of thoughts, some of which have been pursued quite rigorously by the Healthcare Select Committee. And this is the idea of moving to a single ring-fence budget for the NHS and social care with a single commissioner from local services. Now, the complications of how that works and the democratic, if you like, consequences of that are really very, very significant. In addition, they propose introducing a new care and support allowance, which I understand would be available to and replace something called attendance allowance at the moment, which is available to people with mostly at least moderate care needs at an earlier time than they would be eligible for local authority support, and that's paid through the benefit system. And then a focus on fairness, again, equal support for equal need, not dependent on how much you can afford. But this is the most important recommendation, and which is where the actuarial profession needs to take note, is that it largely rejects private insurance options in favour of public funding. And this was a key aspect of the Dill-Knott Commission, because it said by putting a cap on long-term care costs, it would make it much easier for the insurance industry to insure up to that cap. Now, the King's Fund, in their work, largely rejects that, and they do it on this basis. They say that there are no signs that private insurance products will emerge to cover the cost of care up to the cap, and this underlines the need for a predominantly public solution to care, adding that the insurers show little appetite for producing new products that would be needed. So it seems to me that that's one of the really key topics for discussion after we've heard from Craig. Now, before we go further, another point I want to make is that insurance options are just one of several ways of dealing with this problem, and not necessarily the best way. This map here, which is something we produced a few years ago now, but which is widely used in different circles, as far as I can see, in the industry and elsewhere, shows an asset income map of the 65-plus population, and those contours represent people with in equal circumstances based on their assets and their income. And what you see there is possibly what you've suspected but might not have seen presented in this way, is that the variation in people's income post-retirement is actually quite small relative to the variation in their assets, where assets might consist of housing wealth and pension wealth and all sorts of other bits and bobs. And so that changes or introduces a new factor into the landscape, because it means that there are different ways of essentially skinning this long-term care cap, as we will see now. So another thing that we've been working on, which has received quite a lot of publicity and which is recycled in different ways, is different ways of meeting those needs for people in different parts of that income asset spectrum. So, for example, I hope you can see that at the bottom there, this is for people on low income with only moderate assets. How do you get them to save, put money aside for their long-term care needs? Well, one of the ideas we came up there with something called personal care savings bonds. It's published, it's been presented to ministers at meetings, and the basic idea there is that it's like a lottery. People buy these bonds, they're like premium bonds, they buy them regularly through their life. These bonds, unlike premium bonds, earn interest, but they also pay prizes. And you can't encash those bonds until such time that you are assessed as needing care. And we found that was a good way of engaging people in that part of the asset wealth spectrum into putting money aside. Now, these people are not going to be homeowners, so they're not going to have the wealth of this second group here, B. These are people that have little income to fairly substantial income, but most importantly, they have fairly substantial wealth, certainly above the average. And by the way, you see two hotspots in that income asset spectrum. The one at the bottom are the people on, generally speaking, most dependent on the welfare system. The people in the middle is the hotspot for homeowners, and assets here are calculated on an individual basis rather than a household basis. So these people in B have substantial housing wealth, generally speaking, which offers the potential for conversion into products such as income stream from equity release, or more normally at the moment, immediate needs annuities, which are available for people at the point of need if they want to go down that route. This category here we call disability-linked annuities. Annuities are very much in the news, of course, and there's a lot of debate about how and whether the annuity market will decline, change, and so on. But disability-linked pension annuities were coined, it's a term coined by a colleague, Ben Ricason, who's in the audience. The idea of those is that if you trigger one or more ADLs, then your annuity increases by some amount, and that extra amount could be theoretically used to pay for some of your care needs. Now note that the problem with this is that for most people, pension funds are their pension funds are relatively small. The average roughly about 25 to 35,000. So it's never going to buy you a very big annuity in the first place. And if you convert it into a disability-linked annuity, you might struggle there as well. But there will be people on that pension spectrum for whom this could be a very good product. So you get to see what I'm talking about here, that there isn't one spanner that fits all nuts. It's really a quite complex landscape. And then we come to insurance products, which is what we're talking about tonight. Now, insurance products are there to protect your assets, possibly your housing wealth, possibly other assets that you may own. But again, there is a difficulty. As we will see later, I think, insurance products for long-term care are really quite expensive, so you need to have a fairly substantial income in retirement to be able to afford them. And then, of course, there's the final group, the people that have considerable incomes and who may be able to self-fund, so they're not affected by any of these other considerations. Now, there's a further complication, which is the means test, because if you're inside this boundary here, in the bottom left-hand corner, by the way, the means test is a bit of a nonsense, really, and we've developed a much simpler version of it, but I'm not going to bore you with that tonight. The key point is that boundary introduces all sorts of incentives and behaviours into the market, and whether or not people will enter into, for example, an insurance contract or otherwise. And you can see that the basic problem is if you are, or you will be, or you enter at some point in your care journey into that area, you might be eligible for some state support. And so you may cut off your options if you enter into the wrong contract with a provider. So I'm not going to say any more about that. That's probably something for discussion. But what's become clear from all this work is that there are multiple product ideas out there for different segments of that market. And just this year, Tom Kenny and colleagues produced a very interesting paper with lots of ideas about how to use the value in your pensions to help pay for your social care. And there are other products, other product types in publications, some of which I'm responsible for. So I'm only showing these because they're the ones I know most about. But to give you a couple of ideas, this piece of work with Demos that we published earlier this year had a couple of ideas in it which were novel to the market. One was because insurance is expensive, the idea there was that you might use some of the equity in your home to buy a one-off premium at some point, maybe 60, 65 years, and if that insurance was triggered, the insurance company would pay your care costs. But if you died without needing any long-term care, then the insurer would get that proportion of equity that you had committed to buy that product. And in modelling, we showed that the amount that you'd have to give up is reasonably small relative to house prices today, and that will be quite a good deal. As far as I know, no one's taken that up yet, but it's really worth thinking about. Another idea was to get people to ring-fence some of their assets into what we called care accounts at some point near or just after retirement, in return for getting a better state support if care were needed. And the idea here was to induce better forward planning, because forward planning is one of the things that's lacking in this area. Another idea, which is would be to significantly expand the equity release arrangements that exist. The market is much smaller than its potential, and we saw a role here for the state in providing a different and perhaps fairer playing field for that kind of product, in which housing equity would be exchanged for additional income in old age to supplement the state pension and the other pensions that they'd forgotten to save for. And then, of course, there's some very familiar products there. People know about this field: immediate needs annuities, which companies like Partnership and Just Retirement offer. And the idea here is that on going into care, you can exchange a lump sum, perhaps the value in your home, for which you would receive an annuity that would pay your care costs until death. I've already mentioned personal care savings bonds as well, which were launched by the ILC about a year ago. So what are the expected personal costs? I've taken this from Tom Kenny and his colleagues' paper, just to give you an idea. This doesn't include hotel costs, which tend to more than double those figures that you see. And what it shows is that it depends very much on how long you live once you go into care, not surprisingly. It's a very skewed distribution, but obviously the longer you're in care, the more the costs will mount up. And here is another chart taken from the same paper showing the approximate probability of reaching the cap by age and gender. And you can see that probability declines with age and is heavily skewed towards females and not males, for reasons which you should be able to figure out for yourselves. So what's happening to life expectancy? This is a new way of thinking about life expectancy and how we can foresee the future. And one of the problems with projecting life expectancy and mortality in general is that the projection methods tend to be unbounded. In other words, you extend your regression line, put crudely, and it just goes off into the distance, into infinity, or if it's going the other way, it goes through zero. So it's not very helpful. So what we've done here is we've used a concept which we've refined and developed based on what we call 10-year partial life expectancy in 10-year age intervals. And the beauty of this method is that life expectancy cannot exceed a 10-year limit. Okay? So what you can do is you can project life expectancy over the next 10 years in any age interval, and see to what extent it's likely to hit that limit over what period. And it turns out that these logistic curves neatly fit the time series. And there are a number of things that come from this. I won't bore you with all the details, but there's clearly a lot of potential for life expectancy to grow further and faster, particularly in the age group 70 to 90, which in theory ought to make the market for long-term care insurance and other these products more attractive. At least I hope they would, but also potentially more expensive in some cases. In the short term, as I said, most of those advances would be in the 70 to 90 age bracket. But also importantly, but not shown in that graph, is that men will converge with women in terms of life expectancy, which of course has its own other implications as well, because it means that households and partners should hopefully stay together longer. At least I'm hoping that that's what they want to do. So we call this the jam jar model of life expectancy, and the process can be likened to a series of jam jars that gradually fill up over time. And since 1990, they've been filling up much more rapidly. So the colourless part of that chart, the columns, are what, if you like, we call available years to go. And what's really striking about that is that there's not really much movement in the centenarian age group. All the key action is occurring at younger ages, as I've already said, between 70 and 90. So we can expect that that's where this is going to happen. So all these concerns about centenarians being overwhelmed with them may not come to pass, at least according to this model. So today we're talking about issues facing the LTC insurance market, and there are a lot of issues actually, and some of them are there, and I've mentioned some of them already. But what we're going to hear from Craig in a moment, as I understand it, is the issue of adverse selection and the genetic predisposition of individuals and the impact of those features on premiums and other consequences thereof. Thanks very much.
So thank you, Liz. So I'd now like to ask Craig Adams to introduce his paper. Just a bit of background on Craig. He's got a BSc in Actuarial Maths and Statistics from Heriot-Watt. He then went on to work for Friends Providence, working on their protection business. Went back to Scotland and joining Scottish Widows in 2008 to 2010, and then went back to Heriot-Watt to study for a PhD after sitting what were hoped to be the last actuarial exams. Failed both, but passed his PhD with a thesis entitled Adverse Selection in Insurance Markets with Genetic Information. The first paper he's produced is titled Impact of Known Breast Cancer Polygenes on Critical Illness Insurance, and that was published in the Scandinavian Actuarial Journal in 2013. Given his experience with the actuarial exams, he decided to go for SA0 rather than SA2, with a dissertation based on part on his PhD, which has then subsequently led to this talk. He's now working at Aegon, performing experience analysis to produce best estimate assumptions, and he's passed his remaining actuarial exam. So I'm going to hand over to Craig.
Thanks. And thanks to the Health and Care Board for inviting me to do this, and Jennifer Chapman for organising. Thanks, Les and Bill. Okay. So genetics is always a very sensitive subject, and within insurance, it's probably more so, because there are fears that it might lead to a genetic underclass of uninsurable lives. So I'm not talking about the ethics at all today. This is about getting a quantitative measure into the debate is the UK has a moratorium on the use of genetic information, so we can't use it in underwriting apart from Huntington's disease. That's only for life policies over £500,000. So with this, there's the potential for asymmetric information, which could lead to adverse selection. So this is about looking at the cost of that adverse selection. And it's not the first study of it. There's been many previous, as Bill mentioned. I've already done one myself. And there has also been something looking at genetic information in long-term care insurance. But that was in an established market. So the premiums had already been absorbed. Sorry, the adverse selection has already been absorbed into the premiums. So this is in a startup market. So the premiums will gradually get into it. Now, it's long-term care insurance, so it's not a product which is sold. So I've got a little bit of a background on it, although perhaps, being this is probably quite health and care heavy, you might know more about it than I do. But it's a product which covers old age care, so post-retirement, really. And it's to indemnify for the costs which have been paid out, which might be limited by an annual or monthly payment or overall sum assured. The government has proposed a cap on lifetime care costs in order to then remove some of the tail risk, but it's only covering the care costs but not the hotel costs, so there is still some tail risk there. Oh. Now, the reasons for causing a claim are twofold, really. You've got functional disability, so that's ADLs, activities of daily living. There's also cognitive impairment, which is dementia, and the main cause of dementia is Alzheimer's disease. And that is a strong genetic component. There are several now known genes, but only one has sufficient epidemiology to get any sort of modelling from it, and that's the apolipoprotein E gene. That's also the largest known, and it's been established as being the largest genetic factor. So there are other non-Alzheimer's disease related causes, and I'm going to group them all together as non-AD. So I want to build a model of old age. Some previous, which I'm going to draw from, in the paper I'll list some more. But these are what I actually take things from. So McDonald and Pritchard, they, as I mentioned, they were the ones that did the adverse selection in long-term care before. But that was only looking at dementia, and only looking at Alzheimer's disease. It includes that genetic aspect, obviously. Because they had very limited data for the post-dementia transitions, Gareth Colgan kind of built on that. His was looking at another aspect, but he built on their transition intensities using a bit of a larger data set. Still had no functional disability. And then Tunde Akodu's thesis in 2007, he wasn't doing a model of insurance, and it wasn't adverse selection based. This was modeling disability into the future. But he had functional ability in there, and that was based on the CFAS-1. There's now the CFAS-2. We were waiting for that to come out, but it hadn't by the time I was doing it. But that doesn't mention genetics in there. In fact, it doesn't split up the dementia at all. So if you put them together, we get a model, a Markov model, multiple state model like this. And the numbering here, so the first digit indicates the cognitive function type, and the second digit denotes the functional ability type. Now, one of the assumptions behind this, first of all, that it's Markov, and then the transition between cognitive function, so going across the columns, is independent of what functional type you have. So it doesn't matter which row you're in, and vice versa. Now, there's no recovery from cognitive decline, but there is recovery from functional ability, and that was something which is often ignored, but in Demi Pritchard's later work, he found that it does actually make quite a difference to the cost. So we've included the recoveries in here. And there's no arrows to death, but obviously you can die from any state. It was just to save the congestion and the thing. So I'm not wanting to go through the all of the transition intensities and where they've come from. I've listed them here, and I've got some slides on what I've done just for completeness, really, so that you can look through the slides and not have to bother yourself with the paper if you want to do it and get anything from it. The key point on this slide, though, is that this model is not about trying to get something which perfectly reflects the old age. It's to get a baseline to see how adverse selection causes a divergence from that, and how that divergence creates a difference in the liabilities and the premium income. Now, so I'm not wanting to dwell on these. We've got a relative risk of mortality, so for each cognitive type, you've got a base mortality with no ADLs, and then we've got a relative risk which follows the functional disability, and that was for Tundi's thesis. The data in his, he had separate mortality from there. We're just simplifying it a little bit. Mortality improvements, we used the CMI 2011 model, which was available at the time, but that was projecting for 1 year probabilities. So I had to derive a method here to work with force of mortality. So it's entirely consistent, if you trust my maths anyway. Yeah, I'm not really got anything to say on that. Rattling through these. The onset of dementia. So this is fitted to a European-wide study. It's a pooled analysis of various studies which all use the same criteria, the Eurodem studies, the largest of which was British, so it should be a reasonable enough fit for the purpose which we're using anyway. Now they set it up with exposures and occurrences, so we're able to do a maximum likelihood method, which is an improvement on what was done in Pritchard's work, because they were just extrapolating from some moments. At the bottom there, we're saying about the genetics. So the genetic model that we're using is from, not mentioned there, not said there, but it's from Pritchard and MacDonald 2001. They based that on, what is it? I can't remember. So they've got a model of what the different genotypes, what impact they have, and it's age dependent as well. So there are 3 variants of ApoE, well, at least 3 variants, sorry, E2, E3, E4. So that gives rise to 6 potential genotypes. So you've got 1 each from your mum and dad. So we have a genetic, a specific relative risk for each of those genotypes. Well, actually, it's 5 of them. We grouped 2 of them together, but because one of the groups is very small. But that then gives us a means of calculating the overall dementia onset. Okay, so now we're changing the model a little bit more. We're inserting a state here for where the initial signs of dementia have been noticed by the customer, or perhaps their partner, more likely. So where they're maybe getting the memory loss, or a bit more difficult in understanding and reasoning in daily life. But this is before they've been clinically diagnosed. So this is to give the possibility of adverse selection from a life being able to tell that they've got initial signs, and it's not going to be, it's not at a stage that would be picked up by an underwriter at an insurance company. Now, that gives us a problem in fitting the intensities, because what we have is obviously people who have been diagnosed. So got to try and go from a two-state to a three-state model. For mathematical simplicity, we've got here the rate into initial signs is the same as the rate out. That simplifies it quite a lot. It then allows you to reduce it down to a differential equation, which would actually explode at t equals 0. So assuming that for very small h, we say that they're equal over that period. It allows us to get this initial condition, and then we can solve that. So now, putting into insurance. An insurer, when they're underwriting, they're going to group everyone into this clump. They don't know exactly what state of health the customer has. Now, when they, as they experience some claims, they can kind of get some more knowledge from that. So there are three key events from this. Well, suppose four, gets and posts, yes, because death as well. But at the inception, the insurer just knows that they're in one of a group of, say, 4 or 6, or they don't know which one. So they're assuming based on their pricing basis what the general mix is. After there's been a claim for functional disability, at that stage, at that moment in time, the insurer knows that, yep, they're in, they have at least 2 ADLs. So they can then model, because it's Markov, they can model from that point on what the functional ability type is, so moving up and down through the rows. But they don't know still what cognitive type they are. Could be one of 2. Or 3, and also there's the genotype as well. So once they have a claim for dementia, that information is irrelevant now. It doesn't matter what genotype they had or what state they started in. From the point of dementia claim, everything is irrelevant. It's just modelling forward from where they are now, because it's Markov. So they can do that perfectly and get the modelling, well, according to this model anyway. In reality it would be different, but in a Markov world, you can model it perfectly. So by way of an example, if you think of a life who started off in state 5, and let's say the insurer was underwriting so that 0, 1, 2, 4, 5, and 6 were all in one underwriting class. The insurer just sees it as one block. So they don't know where they were in that. But then this life claims in the functional ability type into state 7. At that stage, that's moved into that period C. But then when they recover, they're going about their life, and then the claim again is state 7. That doesn't give any additional information because they already know about the functional, they're modeling that already. But then when they move into the dementia type claim, that gives them the knowledge that, okay, they're now in period D, the post-dementia claim. So coming to the payments under a policy, as I mentioned earlier, they could be restricted by some annual limit or an overall sum assured, and the government's imposing a cap on the care costs, but not the hotel costs. The hotel costs being what you're paying for your room and board. So I don't really want to go through all that. It's just at the bottom here again. It's difficult. The result of doing that, because it's separating the Markov nature of moving around of the health, it's separating that from the actual payments. They are now path dependent. So that becomes difficult to solve. And what I've suggested doing is simulating life histories. And then when we're doing that simulation, we're simulating the movement around the health model. We can then attach payments to whatever state they're in, whether it's paying a premium or if they're receiving a benefit. So we can then find what the present value of those are. And in order to support the information development that's going on as they learn what period they're in. They can then say adjust the premiums accordingly. And I'll come to that later, but in order to do that, we record all of the benefits which are in the period P. That includes everything which comes later, including all of the later periods. Anything which you're in period C is just what the functional disability, and then anything that leads on from that in the dementia period, and then with the period D, again, just whatever's in dementia. So if you've simulated a large number of lives, take an average of that, then we get an expected value. So bootstrap method, but that's good too. No. And another model here. So this is putting it into market. So this is a life starts off untested and uninsured. They could then become tested, find that they've got a genetic predisposition for Alzheimer's, and then there would be a different rate into insured than what there was before they were tested. So then we have a state for being insured as well. Now, premiums are calculated conditional on having the insurance. So this is simply saying that of all the people who are insured, and one of those parameters is not actually set how it's gotten, but it's in the paper, then we get this conditional probability. Now that is entirely determined by the rate of insurance purchase according to whatever state you're in, what genotype you have. So that therefore forms your basis. So that is, without the tilde, that this is going to be the pricing basis, and I'll put a tilde over it for denoting an experience basis. And that's all. It's always going to be under the eta there, but it's mu which is driving that. Now we get a base premium, which will be, I'll come on to, that'll be adjusted and scaled up. But because of Tesla SHA, we've got to have a unisex premium. And I'm assuming that they recognize the ratio of males to females immediately. So that's why we have the something in the brackets there. It's scaling it up for the proportion of males and proportion of females. Otherwise, it would all just be what's at the end there. And it's a common trait which is I'm going to go through with all of the information development things, that you've got this summation on the end. You're scaling up by some proportion. Excuse me. And then you've got this summation of what the benefits are at the bottom there, the premium would be just on the pricing basis. So now, as I keep mentioning, the dynamic premium rates. So the insurer observes its claim experience, and through that, it can better estimate what the mix of who it's selling to is, or at least it can adjust the premiums by some amount to say, yeah, we're getting it's a bit more expensive than we realised. Let's scale it up for that amount, and that's based on what they're seeing in their claims. So this, we'll be doing that through looking at what the claims were, what the premium, what they were charging at outset, and now, given this new experience, what they think they should have been charging. So they're changing what their expected future amounts are. So they can see what their actual benefits are, and then they're changing their future expectations of the future. So if we set up some notation, so we're getting this expected amount. If you set it as think of it as a stochastic process, then the claims experience becomes your filtration, and we can have separate it out, looking conditional on this filtration, what your claims experience is. You've got this actual, and you've got the expected future. So you have then look at what the actual is. Obviously, an insurer, depending if their data is any good, which is arguably not necessarily true, but they should know how much they've paid. Data systems probably might negate that statement. Now, we have to work it out from our simulations. Now, because this is actual, we can use the actual experienced basis, the tilde over the mu there, and work out, okay, this is what the mix was. The overall benefits from that stage would have been this, and take out whatever happens after year C. So this is calendar years, done every calendar year. Coming on to the expected, in the first period, in period P, when there hasn't been any claims for this block of lives, the insurer just has the pricing basis to go on for its mix, but it has the volume of business won't follow that, because that's going to be changing according to whatever the lives have been moving out of and claiming. So they have to scale that for the volume of business that they have. Period C is the more complicated one, because we have a knowledge of the functional disability type, the volume of they don't know where they started, but they know it from the point when they claimed, and they can model from there. But then they don't know the mix of the functional disability type. So we have this, looking at, we have the knowledge of functional, but not of the cognitive. So we have there the functionals being taken out of the final summation, scaling up according to the size of each of the functional groups. And period D, when everything is, anything useful is known now, it's very simple. Just pulling it out of the summation would end up doing the same thing and resulting in this. So we're using the experience basis. Now, from that, we can get our repricing adjustment factor if we put all those into that expectation. But the older business, the makeup of the market will be changing over time. So the older business won't be so relevant. The costs which have been occurred over the adverse selection from them won't be so relevant. So we've got a simple weighting factor. It's just a reverse sigmoid type function to attribute lower weight to the older business, larger weight amounts to the newer business. Now, summing up over everything that we know, we can get this adjustment to the base premiums. I've not noted there, but obviously, so that goes from after the first year. I should have said there that in the first year, this psi is 1. But so now applying it into a UK market, get some results here now soon. So long-term care in the UK, as Les had mentioned, there's not currently any deferred needs cover for sale in the UK. The situation in Scotland and the rest of the UK is different. In the rest of the UK, there's a means tested, but overall care is paid for by the individual. The means test is currently at something like 27,000, I think. Over that, you've got to probably sell your home. Whereas in Scotland, the Scottish Government took the advice of the Royal Commission in 1999 to pay for the care costs, and does that through a fixed contribution, but not paying hotel costs. The UK government has proposed a cap. What I've used in my work was what was previously suggested. It's changed since then. So it was 75,000 from 2017. They've brought it forward a year to make it 72,000. This is all done with the 75,000 from 2017. Now, getting in some parameters for the costs of care for each state. It's just an average of the UK. There was a table that gave it by region and weighting that by population from the ONS. The number of in-home care provided, the number of hours, that wasn't so clear what was being provided. So in the paper, I've put that as a scenario-specific parameter, so I've not set that until putting the results through. Here I'm using 1 hour, H equals 1, sorry. But it could, because it didn't really make a difference to the shape. Now, some sort of results here, as I promised. So now this is the premiums that would be charged. The purchase time, the market starts at 2013 when I was doing the research, and then at any time since then. So that's the number of years since 2013. Now these are the premium rates that would be charged if an insurer knew what genotype you are and what initial state you were in when you were buying your insurance from. The thick lines are what would be being charged in a small market, aggregating everything. So there's what it would be if there was males, if there was females separate, and then the blue line for unisex, which would be charged in the UK. So what we can see from this is that these are only for the no ADL. In the paper you've got the more complete, but there's obviously quite a large discrepancy here between initial signs and healthy. That makes a huge difference because obviously you're closer to a claim. Females are substantially higher than males, and also when you're healthy, the genetic aspect doesn't make so much of a pronounced difference as it does when you're closer to developing dementia, which makes sense because you've still got an extra step to go through in order to develop it. But you can see that there is still some difference between them, and it would be to their advantage to buy insurance early on when the premiums are low, if they had the test knowledge then. If we have the adverse selection costs, so what would be the premiums adjustment being made and what they should be made if we look at each source of adverse selection in isolation. So it's one thing happening at a time. Now, the black line on the right-hand side, the black line there at the top, that's if people with the initial signs of dementia are buying at an increased rate. That's the highest, but that's not recognised very quickly. On the left, that's the rate at which it's being recognised. The amount that the premiums are being adjusted by is going up very slowly. Whereas if the insurer wasn't able to underwrite for functional disability for some reason, then that has quite a high adjustment that would need to be made to the premiums, but it does get recognised quickly because people reach their claim quickly. If healthy lives weren't buying it, again, that's sort of a similar level to the ADL cost, but it's recognised a little bit slower. And that's probably the outcome that might well happen. If people don't value the product, they're not likely to buy it. Whereas the two lines at the bottom, the green and blue, they're coming from the genetics. So if you've got a low-risk gene, so that's E2 type of the ApoE, and you're not buying it because you think you're low risk, that's not going to entail much of a cost to the premium there, add much to the premium. If you have an E4 type variant of ApoE, that would add something to the premium. It's not as much as the others, but there's a little bit there. Again, that's recognised only very slowly, though. Now, coming on to the progression of costs. So this is the cost of adverse selection, the remaining amount that's not being taken care of. So basically, the right-hand side divided by the left-hand side, essentially. But this is with multiple sources of adverse selection occurring at the same time. So this is where the initial sign, a bit later the initial signs, and with one ADL buy at a higher rate. So what you can see is that in the smallest market, you have the largest cost, which makes sense because relative to the size of the premium, you're not going to have many healthy lives. You're not expecting many people to be buying it, and then you've got this very high rate of very poor lives buying. You're going to have substantial cost there, but that's recognised the quickest. It's quickest to adjust. And the middle one, the males, if they were paying a male-only premium, the premium would be a lot lower, and that gives rise to a larger adverse selection cost than it would do for the females, which is on the right-hand side. If we now add in the genetics, so behaviour changing after genetic tests, so lives with a high-risk variant, so the E4 type, buying at a higher rate, and lives with an E2, choosing not to buy. Well, this is before they reach any of the other, so before they reach initial signs or 1ADL, that would cater for that as well. This reduces the costs somewhat. So the reason for that is that lives with this higher risk, with the high risk genes, they would reach the initial signs ultimately, but they're buying earlier, so the costs associated with that are lower. And that causes the adverse selection costs to come down. Now, if we say that functional disability can be underwritten, as it likely would, it changes the pattern a little bit more. There was a slight hump, now it's a lot more pronounced, and the costs have gone up. So you've got fewer people adversely selected, but the costs have gone up. And that's because the premiums will have gone down, because you've got, you're not having these people who are close to claim, you're not having to include that in the premium. So the overall premium has gone down, and you're now getting the adverse weighted over a smaller premium, which puts the cost up. The hump is because as the youngest lives get older and reach the more likely to be in the adverse selection, in the initial signs, so it makes it more pronounced. So now, I think Les has already come on to this already. So this is the probability density function for the care costs, the distribution of the care costs under my model anyway. This isn't what would be, as I said before, as what would be in reality. Now you can see that the proportion of lives who are reaching the cap is fairly low. So it's not benefiting a huge number of people. It's not really related to the genetics, it's just something that I could do from the results. But anyway, so my conclusions. Adverse selection is, the costs are higher associated to the initial signs of dementia, and that's also the slowest to emerge. So that's going to be where the greatest risk would be. On its own, genetic tests do bring some adverse selection cost, but it's small relative to the initial signs of dementia. And when it's occurring with other sources, it brings it forward to a point where the cost of it is lower. So it's actually beneficial, perversely. And as I just said, the government's cap doesn't provide a great benefit to most people. But it could limit some of the tail risk. That would be another study. We'd have to analyse that. This is just looking at the cost of adverse selection, not the risks. So that's it.
Thank you, Craig. Okay, so I'd like to open the discussion now to the floor. And so I'm looking forward to some interesting and stimulating debate. I would like to encourage as many members who would like to contribute to do so. Can I first of all ask those who think they may wish to contribute, could they put their hand up just so I could get an idea of numbers? Well, that's all right then. I'm going to have to limit you to at most 30 minutes. Thanks, Peter. Okay, so I just wanted to make people aware and remind people that the meeting is being recorded for publication in the British Actuarial Journal. So please clearly state your name before making your contribution, and please can you wait for a microphone to be brought to you before you bring your contribution, and make sure that you speak into the microphone. So on that point, I'll sort of open it out and ask for the microphone to go to Peter to get us started.
Peter Banthorpe. Just wanted to test a few of the assumptions I could, just to kind of understand whether or not we think that when we test some of the assumptions, whether that's an overstatement or understatement of anti-selection costs. So the things that occurred, one, the assumption that the model is Markov, with dementia being a degenerative disease. How does that stand up to reality? Two was, you correctly identified insurance companies aren't the best with their data, but there are some very real issues around kind of reporting lags, and you don't get data immediately, so does that allow the anti-selection problem to grow bigger before you can actually deal with it? And then the final point has just completely slipped my mind. Lapses. I assume you're assuming that this is a single premium product, so the effect of anti-selective lapses isn't material.
Well, so on your last point, for these that I've had on the graphs there, that was the regular premium. In the paper, in my SE0 I had single premium in there. I'm not sure if I put the graphs in for single premium. I do make that comment because the premiums, if I go back to the slide, there's at the end there, it sort of starts going down. So at that stage, it would be lapse and re-entry would be perfect for regular premium. So I was suggesting that because a single premium would be very large, and you've got this risk perhaps somewhere in the middle, advanced payment but not fully. The testing of the model, I'm coming back to that then, the Markov assumption simplifies the situation quite substantially, but the reality is we would expect something of slightly different. I don't know how it would impact upon the adverse selection costs, because, I mean, as I say, this is getting a baseline. So we can say that the genetics isn't going to be that much of a big deal compared to the initial signs, but I wouldn't suggest using this as a pricing model or using it for reserving. This is just getting us these conclusions, looking at getting some sort of an idea on the genetic component to feed into the debate over whether it should be usable in underwriting. And sorry, what was the second question?
Lags in
Lags.
Identifying. I assume it can only make things worse.
Yeah, I suppose that would be a nice little thing to add on to it, have some sort of IBNR. It would delay the adjustments that would be being made and increase the costs, but it would be, I think that if we've got adverse selection occurring in the market, they're going to be likely to claim out, like put their claim in. So how much IBNR would be, I don't know, has there been, do you know, pass on to you, since you actually know about the industry perhaps?
I'm sure with all business there are late reported claims, and sometimes it's down to the individual and sometimes it's down to our own administration staff.
Thank you.
Chris Harvey. You indicated that there's a significant genetic predisposition to some of the dementia conditions. To what extent is underwriting on family history any protection against anti-selection for those conditions?
Well, I don't think that the family history would be quite sufficient, but the knowledge of genetics over Alzheimer's disease isn't very well known. But because there are a lot of different genes expected to be at play here, there's, with coming from you mentioned my polygenic breast cancer model, that family history on that wouldn't really play too well, because you're getting so many genes coming into it that there's the risk that your parents have, they don't necessarily pass on the combination that they have. Well, they pass on half of the combination they have, but because there's so many different genes, one plays off against another. So I wouldn't expect necessarily, if there are, there are 5 others known, but I think it's quite likely that it'll be even further, quite a large number. So a family history from that wouldn't be too great a teller.
Rather than just putting Craig on the spot with the questions, can I as chairman, my prerogative, can I ask the audience a question in terms of the thinking here is in terms of individuals being able to select against an insurer. So the general question, how good do we think insurers can be to spot this compared to an individual? Is an individual going to be in a better position to spot the early signs of dementia? Or is an insurer going to be able to come up with appropriate underwriting tools and tests to enable them to spot that? Because we certainly know sometimes in terms of life insurance, insurers will spot problems before the individual does. Anyone got any views on that?
Silence. Have you got any views on that?
I mean, insurers have attempted to deal with cognitive impairment by asking memory recall questions. I mean, that's the classic way used both in the UK but also used in North America. So ask somebody to remember 5 words, then have a conversation with them and ask them to repeat the five words. But do you think individuals will spot when they have difficulties?
Hello, Doug Palmer. Just on that last point, my understanding of a lot of the current research on dementia is that there's a great deal of effort going into testing for early onset, and the emphasis being on looking for chemical changes ahead of the behavioural ones, which we spot. So in terms of answering the question that you put, I guess it's a case of cost is going to be a factor, and how easy it is for individuals to have access to the testing compared to insurance companies, and the difficulties in using that for underwriting or adverse selection.
So under that scenario, the insurer may actually be in a better position to judge the early signs if they we're able to ask for the test and to interpret the result rather than the individual.
Well, I think Jason Hurley. I think as we've said, that the products that are sold at the moment are immediate needs annuities. So in that case, the onus is on the customer to open quotes, prove, close quotes, that they've got the medical impairment and how severe it is. But in terms of whether customers will do it, I agree with Jack, I think his name was. It's obviously going to depend on the cost and how easy it is for people to get hold of that information. I certainly think it's a risk that insurers should be aware of, and I suspect won't react as quickly as they probably should.
John Jenkins. I'm no particular expert on this, but I would be quite significantly concerned about this risk of selection, because it just occurs to me on a common sense basis that the individual in question may not spot that they're at risk, but their husband or wife might be well placed to spot that they're at risk by observing changes in their normal behaviour. And if they are fairly wealthy, they might be able to get a policy out and therefore anti-select before the insurance company is able to pick it up with whatever tests it actually has available to it. So that's a comment. In terms of the question, I wonder whether, Bill, you might be able to summarise for my benefit and everybody else's, what actually is the state of interest and activity in the UK insurance industry and the reinsurance industry in terms of this sort of business. Other than the sort of impaired life annuities and immediate needs annuities, is anybody writing this business at the moment and underwriting these risks, or is it just a product that we think will come of age at some time in the future?
I don't know if anyone else wants to comment. I was just going to say, I mean, as far as the UK market is concerned, nobody, to the best of my knowledge, nobody is selling a pre-funded product as of today, but they did do back in the 90s. And they stopped selling it because of the difficulty of distribution, not because of the difficulty of experience. However, I think one of their early pricing assumptions was that interest rates would be around 6-7%. So perhaps over 20 years that hasn't quite worked out exactly the way they expected. But pre-funded contracts are widely available in North America. They are available in France and Germany, so in parts of Europe. So there are certainly other markets where these products are available, and my own personal view is the biggest issue is distribution. The problem with pre-funded products is actually getting the right distribution, and because nobody has cracked that, that's one of the reasons why the product has disappeared.
Sorry, it's me again. I mean, the way I see it, I mean, Les hinted at it when he was talking about, I think it was called the King's
Fund.
So already they're changing the regulation. Would you really expect insurers and reinsurers to develop products and people to sell products long term, given the political nature, how quickly the regulation could change? There's no tax incentive. Products are inflexible. Yeah, there's plenty of other products around that would be more flexible and more tax advantageous for the customers to use for saving.
And that's a good point in terms of some of the markets where it is successful. It's compulsory, or there is some push from the state to require you to do it.
Can I just add that? Personally, don't believe that long-term care and periods of social care leading up to periods in institutional care will ever be completely free under any of these King's Fund scenarios. In fact, what they were talking about, if you read the small print, is only people with the most critical and possibly substantial needs. So for low and moderate needs, they clearly see that people should continue to support themselves one way or another. But it does actually put a big, if it came to pass, a big brake on in terms of our thinking about this market and which would be the best products to meet all possible needs. It's clear that the system needs more private money injected into it because public funds are very tight and budgets are being cut everywhere, and it may be that we just have to think more carefully about the products that would be most suitable, and also think about these potential interactions with what the state will give you. So, for example, it seems to me that what you don't want to happen is to take money off people that have saved for care, because the means test says that they deduct pound for pound against their income. So I think that would be a very, very big mistake, and it will actually take all the wind out of the market in terms of creating a market for private long-term care products.
Michael Martin, a couple of questions. In terms of the application form, could we also not ask the spouse if they noticed any difference in the behaviour of the other party? But the other one, given the size of these premiums, is there not the case for a face-to-face underwriting case, where rather than an application form, a face-to-face, we actually can test maybe their physical ability and also their memory loss and such like, rather than where typically we've got an application form for a £20 term assurance, where clearly we can't do face-to-face investigations.
Anyone, any comments on that one? I mean, certainly it's markets where it's sold, they go in for a lot of telephone interviews, so they don't do it purely on the basis of a written application form, which you would be happy to do with many other products. But any thoughts on why not use a nurse and assess the risk? Could you come up with could you manage the adverse selection sufficiently?
Would that not put off people a bit though? I mean, if it's already a product which is having difficulty in selling, if you're adding this layer of intrusive underwriting, then it's going to put them off even more. It's just a thought.
If you're 70, would you like somebody to come around and have a cup of tea with you?
I don't know how it works in the US market, but I have looked at websites where you can apply for insurance online. I don't know whether that's the beginning and the end of it, or whether there are other hoops you have to jump through before you get a quote. Does anybody happen to know or have investigated any of those websites?
I mean, the US market is quite common to have a medical exam for standard term assurance. They rely a lot more on blood testing, and you can't do that over the phone or online. So they do have people that will come and visit you and take samples. Sorry, repeat that for the audio track.
Yeah, Tom Kenny. In the US, I understand that they do nurse screening for long-term care, pre-funded long-term care. So I'll send someone along and they'll take you through a variety of tests. It could be, I think there's a dementia test that they take you through, and they'll probably take a few samples as well.
And they have that nurse screening system set up for even basic term assurance. So they already have that infrastructure in place. Obviously, it's a different set of tests.
I mean, I was going to make one point around the products, pre-funded products. It strikes me that the risks involved in pricing it accurately, given the long-term nature of it, is quite substantial, and the costs also seem very high. So in my own view of what I've seen so far, I can see long-term care, pre-funded long-term care, being a rider on some other products where it provides some sort of top-up insurance, but I can't really see it being pre-funded, providing full indemnified cover or even anything approaching the true cost of care in the UK. And certainly from what we've seen in the US, the pre-funded market, as kind of what's been modelled here, is declining. The cost of insurance has gone up, and the providers in the market have declined. So there's only a small number of providers in the US that offer it now. And the sort of products that they're offering there now tend to be sort of combo products where they're combining savings with some sort of accelerated claim. So if you get a condition that qualifies, some sort of long-term failing ADLs or dementia or something like that, then it may pay out an earlier benefit. So it's sort of like accelerated critical illness, accelerated long-term care. But that's just a thought based on what's happening in the US, which is sort of we're talking about pre-funded here.
Can I just add something to that and ask Craig a question? Do your premiums presume hotel costs as well as personal care costs, and would it not be a lot cheaper if you separated out the hotel costs and perhaps assume that the individual can afford that out of their normal income in retirement?
It does include hotel costs and care costs. The policy, the type of cover does provide for that, though, doesn't it? So I was trying to just reflect what the product does. I never considered stripping the hotel costs out. I did do a version to reflect more what would be occurring in Scotland, where you've only got the hotel costs. I can't recall what the result. I've got my thesis in my bag if you're interested in seeing the graphs.
Well, simplistically, it's probably the ratio of hotel costs to total costs, isn't it?
Well, it's just the graphs of the adverse selection costs rather than the premiums. But I can't recall what the situation was.
It's just that kind of product may make it more affordable for more people, because the average income in retirement of the people we're talking about is probably in the region of 20,000 a year anyway, which would be sufficient based on figures I've seen and what the government suggests hotel costs might be in the future, which is around 12 or 13,000 pounds, I believe. Just looking at Tom there for confirmation. But, yeah.
Well, if it still meets the customer's needs, then it sounds like it would be a viable option.
But the top-up idea must be, one of the ways to go with all of this, because people will have multiple sources of income. They may have an informal carer. They may only need to cover holiday periods and other things during the year. So there's scope for a lot of creative thinking. You might be able to launch a product that gives you 100 hours per care per quarter or something like that, and that would change the landscape quite a bit, I think.
It is a challenge. What do people think has changed so much that 15, 20 years ago, major household names, insurers, were quite happy to enter the pre-funded long-term care market? And to the best of my knowledge, they all withdrew simply because they couldn't actually sell the volume of business to actually justify that level of investment. But nobody withdrew on the basis of claims experience. Are we all a lot more risk averse today?
Well, there's kind of a lot of coverage in the news for reform of the care sector. So people are quite unaware of the government don't cover the cost. So I don't know whether advisors were pushing it before, but if they're unaware that it's something that there's a gap there, then they wouldn't buy it. But if it's getting a lot more coverage just now, because there's this, the Westminster has seen the need for reform, although I suppose there was the Royal Commission in 1999, which gave recommendations, so that would have got coverage. So maybe that's an invalid point, I don't know.
I suppose that might be my question in terms of, is that the one thing we've learned over the last 15, 20 years? You can't trust governments. So actually, going with the product is where the difficulty, because it was the Royal Commission in '89 that actually persuaded some of the big insurers to actually enter this market, because they thought they would get volume and it would be a key line of business.
I do think the other challenge around the pre-funded market, as someone else mentioned, is the level of political risk that the regime is changing quite a bit, and even with the regime that they're planning to introduce, there's still a lot of uncertainty around exactly how it will work. For example, the definition of the eligible needs is still to be finalised, and that's a potential political tool. They could play around with that definition at any point in the future. So if you're trying to design a pre-funded product that will pay out in the future at the same time as someone's eligible needs, or someone being deemed as having eligible needs, you want some sort of certainty that won't change dramatically. Otherwise, you're opening yourself up for complaints from policyholders saying, I bought this insurance thinking that it would cover me in this situation, and now it doesn't, and there's that huge risk. But also, I think now versus 15 years ago, we've got Solvency II and risk-based capital. So you have to really understand the risks you're taking on, and offering a pre-funded product, you've got quite a bit of investment risk, and your claims risk is huge, isn't it? Someone buying this product at 60 and not expecting to claim until about 85. That's a long time, and I'm not aware of there being particularly good data available in the UK right now on care, and it's one of the challenges that we're trying to address, is trying to get good data sets that would actually help people design and price products accurately.
Can I just add two other reasons to try and explain what Bill's question, or try and answer it, which is that survey after survey shows that people think that social care is free, and it's taken many efforts on part, and not successful efforts necessarily on the part of government, to change that perception. And that in part is because the system is very complicated, in part because they get healthcare free, and in part because they confuse healthcare and social care as being similar. I think the second reason is that it is expensive, and it would only suit quite a narrow slither of the population based on my analysis of the income asset spectrum. I think Tom was right. There's also a problem with these long-term kind of contingent products, because if the environment changes, then they could become, a bad buy, and then the insurer would get the blame and not the government. And it is, your point about what the eligible needs will be. I'm not sure whether I've got this exactly right, but it's going to be set at quite a high level. There's 4 levels at the moment: critical, substantial, moderate, and low. And I think, maybe someone could correct me, the government is thinking of setting it at critical, but there will be a lot of local authorities that will offer substantial as well as critical. So there's an element of geographical variation around, and whether in which of those levels would insurers recognise critical or substantial must also be an unknown and difficult judgment as well. So I'm not sure that these kind of contingent products are the best way forward. Maybe savings vehicles are essentially the best way forward, because it's much more difficult to take away your savings except by inflation than it is to renege on your commitments, whether it's your fault or not.
Conscious of the time, is any one last contribution?
Hi, Craig Swatton. On your point around the sort of culture of thinking that social care is free, I think that is something that has changed in the last 20 years. I think the people that are approaching retirement now are the people that have seen their parents living much longer lives in retirement, and potentially having to sell their homes to fund the care. And there is that culture of home ownership in the UK that means there is a desire of people approaching retirement now to not have to sell their homes, to keep a hold of them, to be able to pass them on to the next generation. And having seen their parents go through that situation of having to fund their long-term care, whereas the previous generations 20 years ago, that was perhaps a new situation coming through.
And in France, there is a legal requirement that you are responsible for your parents, so you have to meet the cost for your parents. So, I think on that point, it remains for me to express my thanks to our speakers, and I'm sure you would like to join me in giving them thanks to the authors and to our opener who participated in this evening's discussion.